What can we learn from what's happened over there in the States? How much of that can be applied to what's happening on Chinese equity markets?
Yeah, I think to your very question, I think the yield curve increases on the 10-year, the interest rate. I think that has been repriced in the U.S. across sectors, and I think some of that is also happening in the China market. And secondarily, liquidity on the margin is tightened a little bit, and that is same sort of effect, but going through a different path. And so what we've seen is A shares and H shares all responded to the marginal liquidity change, and then also pricing in better cyclical growth ahead. So if we look at how the different sectors have retreated, we definitely see the cyclical growth sectors having retreated less compared to the staples, the core asset that people were holding onto all through last year. And then we have internet that's somewhere in between.
So Wendy, I mean, you just alluded to it. You know, you're seeing a bit of tightening of liquidity. That really could cut back on a credit to some extent. Also, it could have an impact on funding costs. Is this all a concern for you, and how does it inform you when you invest?
I think for the China market, to your question, the 10-year yield is less of a concern on the CGB, but it's really the incremental credit growth. We saw very strong credit growth in January, driven by households buying property, and then enterprises taking out medium long-term loans for CapEx. And it was growing at 13% year over year. So the UBS projection is that by the end of March, we're going to see that coming to 12.5%, which is not a huge marginal change. But I think what got the market more concerned was the 6% GDP or higher, this growth target for 2021, which leaves room for structural adjustments. So there is upside, there is potential for structural adjustment, and the consensus GDP forecast is 8 to 9% at this point. But I think there is going to be a period to be proven which is going to be the case. And so I think there is a bit of a pricing of the potential for this, headline number of 6% and higher GDP.
Well, is that the logic behind you raising your base case targets here and also raising your case for 2021 year-end figures as well?
We did that a little bit earlier. Suffice to say, when we look at the valuations for MSCI, CSI, HSI, the current valuations vis-a-vis the growth that we think it could achieve is actually reasonable. So at about 16 times, 13 times, and 14 times respectively. And the growth we anticipate is about 17%, 17%, 18% on the three indices. Now, when we look around the world, everybody is trading at reasonable standard deviation above historical mean. Generally, it's 2 times standard deviation above historical mean. And when we study how these market trades, it's really when we get in a period of supercharged growth and the multiples respond to that. For China, I think with the cyclical recovery globally, yet reopening is still improving with the vaccination going up in the DM markets, we could sort of see a solid path to growth. And furthermore, when we look at bottom up, what stocks we have in A and H, we do have compared to 06, 07, 2015, 16, a better selection of companies. And then finally, the demand for equities is also improving on the margin. So when we look at China's GDP, 16 trillion USD, equities in 3 parts, 12 trillion onshore, 4.5 in H, 1.9 in the US. And there's a structural need for onshore money to seek these targets. So I think if we step back from the current volatility in the market responding to the rising yield on the 10-year treasury, and then also liquidity changing on the margin, then we could still get to that scenario on a 4-year basis.
Wendy, very quickly, we've seen this before when the CSI 300 has gone into correction territory, that there's been a wall of money waiting to buy on the dip. But you're going to see that as well this time around too. Very quickly, Wendy.
Yeah, we think so. And then the timing is between now and April. I think the earnings season's coming through. We're going to have earnings alerts, and then we're going to see where the 10-year yield stabilize to, and then how bad the liquidity tightening could be. And I think once people get comfort with those metrics, and then also U.S.-China relationship, we should be coming out of the current phase of correction.